Ladies and gentlemen, the CEO of CHEGG bought 25,000 shares of the company on this dip. And when management, especially the CEO, buys shares within the company, that gives me a lot of confidence. What's up, ladies and gentlemen? Welcome to the Beat of Business with me, Ravi Wadan. And today we're going to be talking about 3 growth stocks that are down over 50% that you should consider buying right now. If you're like me, you love buying stocks when they are trading at a discount, especially when they're high quality companies with very good long-term prospects that are simply down due to short-term causes. Now, with all 3 of these companies, I think right now is a great time to start your position or even consider dollar cost averaging over the next few weeks or few months. Anyways, I don't want to waste your time because your time is valuable. Let's jump straight into the video. The first stock on my list is CHEGG, ticker symbol CHGG. CHEGG is an education technology company with a subscription business model, and they primarily cater to college students by offering help with course curriculum. As it stands, CHEGG's platform has over 70 million step-by-step solutions to questions that students may have difficulty understanding. A little side note here, where were these companies when I was in college? I mean, I had to go to the tutoring center for hours just to figure out what the heck I was doing. Anyways, as a subscriber to CHEGG, students have full access to this gigantic database that is continually growing. And in addition to having full access to existing content, students can ask 20 questions per month that are answered by subject matter experts. And once these questions are answered by these subject matter experts, they are added to the database for all other students to view. It's a very lucrative business model because CHEGG pays for that contact once and gets benefits for several years simply due to the fact that college curriculum does not change that much year over year, especially when it comes to subjects like math. Hey guys, my wife just walked in. Zuli, want to say hi? Yeah! Hi guys! From 2015 to 2020, operating profit actually grew from a loss of 57 million to positive 57 million with no signs of slowing down. And as you can see from this chart, over the past 6 months, CHEGG is down over 62%, with a majority of these losses coming after November 1st, when the company cited a significant drop-off in student enrollment. As of today, CHEGG is trading at around $28 a share. It has a market cap of 4.076 billion and a 52-week trading range of $24.25 on the low end and $115.21 on the high end. It's always interesting to see what analysts have to say, and of the 14 analyst price targets that are out there, we have an average price target of $55 a share, which is much higher than the $28 a share it is trading at right now. According to the company's latest investor presentation, CHEGG has the highest level of unaided awareness among college students, higher than Amazon, Quizlet, Khan Academy, and Google. And from 2019 to 2020, the company had 67% year-over-year growth in terms of subscribers, which is excellent. And according to analysts and experts who study the e-learning space, the e-learning space is expected to grow at a compounded annual growth rate of 14.6% through 2026. And ladies and gentlemen, the CEO of CHEGG bought 25,000 shares of the company on this dip. And when management, especially the CEO, buys shares within the company, that gives me a lot of confidence. Now, before we get into the second stock on my list, if you're enjoying this content, please give this video a big thumbs up and consider subscribing to my YouTube channel. The second company that you should strongly consider buying right now is PELOTON, ticker symbol PTON. I think most of you are familiar with PELOTON, but if you're not, they sell interactive exercise equipment and a subscription to live and recorded exercise classes. The company was already gaining popularity before the pandemic, but the pandemic really boosted Peloton's demand for their in-home exercise equipment. And as a result, revenue more than doubled to $4 billion in fiscal 2021. And once people subscribe to Peloton, they generally tend to stick around, and that's why Peloton boasted a membership retention rate of 92% in its most recent quarter, which ended on September 30th. Peloton has 2.5 million connected fitness subscribers, and their management team is forecasting that it will grow to 3.4 million by the end of 2022. And when you think about 3.4 million on a global scale, That's a relatively small number, which leaves a lot of room for Peloton to grow. But just take a look at this chart to see how badly Peloton stock has been performing year to date. Year to date, it's down over 70%, and that's why I think right now is a great buying opportunity. Currently, Peloton is trading at around $41 a share, and as of right now, it's down over 10% on the day. The company has a market cap of $13.69 billion and has a 52-week trading range of $40.84 on the low end and $171.09 on the high end. There are currently 27 analysts that cover the stock, and those 27 analysts have an average price target of $79.85, which is roughly twice the price of what it is trading at right now. As I said earlier, Peloton stock is down over 70% in 2021, and that's mainly due to an economic reopening and a perceived slower demand for in-home exercise equipment. But with that being said, Peloton sales are actually higher this year than they were last year. And to be honest with you all, up until now, I was a Peloton bear. I just didn't think that their growth was sustainable, especially with a reopening underway. Now that sentiment, along with a couple of bad results from prior quarters, really hammered the stock. But I want to ask you guys something. Have you ever talked to or spoken to someone who uses their Peloton? They absolutely love it. You see, Peloton has a cult-like following, and they're coming out with new product lines, they're selling ads, and they're simply the Netflix of online fitness streaming content. And with Peloton being down over 70% year to date, I'd strongly consider adding it to your portfolio. The third stock on my list is SKILLZ, ticker symbol SKLZ. SKILLZ is a gaming company with a unique twist. It allows contestants to wager on their games and doles out cash prizes to winners. Now, the company's business is not considered gambling because the games on its site are based on skill. In other words, winners win because they are better at the game and not because of chances or odds. In its most recent quarter, the company boasted 0.51 million monthly active users, up from 0.35 million the year before. But still, the growth is not pleasing investors because the company is spending so heavily on sales and marketing. You see, SKILLZ spent 112% of revenue on sales and marketing in its most recent quarter. Now, investors feel it should be getting better results from all of that spending. So the stock is down 57.8% in 2021. And just take a look at this chart. Over the last 6 months, the stock is down over 58%. Now, many people like to look at these types of charts as a red flag, but I always like to see if there is an opportunity, and I believe there is. Currently, SKILLZ is trading at $9.26 a share and is down over 6% today. It has a market cap of $3.797 billion and has a 52-week trading range of $7.57 on the low end and $46.30 on the high end. There are currently 6 analysts that cover the stock with an average price target of $15.83 a share, which is substantially higher than its current price of $9.31. And as I said earlier, this stock is mainly down because of disappointment with the company spending more on marketing and sales than revenues taken in. However, if you are a long-term investor with a long-term mindset, the stock offers a high potential upside because of several long-term catalysts. These long-term catalysts include the continued addition of high-quality games to scale the business, the recent acquisition of Arki, which helps SKILLZ reduce marketing spend and increase advertising efficiency, their new partnership with Exit Games, which will make the SKILLZ platform even more attractive for developers to introduce higher quality games, and the growth and adoption of 5G, which will enable more advanced games to be played on the SKILLZ platform. All right, ladies and gentlemen, with that, I'm going to call it a video. And as always, please do your own research and your own due diligence. This video is intended to be a part of that research and due diligence. But I firmly believe that these 3 companies, CHEGG, Peloton, and SKILLZ, all offer great upside for long-term investors simply due to the fact that these stocks are all suffering from short-term pain. And sometimes you have to suffer short-term pain for long-term gain. With that being said, if you guys could do me a quick favor and hit that thumbs up button and hit that subscribe button, it would be greatly appreciated. Thank you all for watching. I'll see you all next time.